All right, so I call it the Apex Wealth Collective Portfolio. The easiest stock and crypto hybrid 3-fund portfolio. You buy, you wait, you get wealthy. No messing about, no rebalancing, just DCA and watch the portfolio blossom. First, we'll dissect the portfolio into its 3 components and then backtest it against the popular benchmark, the S&P 500. Now give this video a like, subscribe to the channel, and stay tuned to see what is in this simple yet extremely effective portfolio. Hey everyone, welcome back to the channel. If you're new here, I'm Patrick. I've been an investor for over a decade, an options trader for 7 years, and in crypto for 7 years. I've grown my portfolio to over $250,000, and I run Apex Wealth Collective, a school community for investors where you can follow my portfolio journey, see all of my buys and sells as soon as I make them, and get access to deeper and more frequent market analysis. Also get access to all of my YouTube content early and get your questions included in any future Q&A videos. Link is in the description below. So here we are. Today, we talk about the ultimate all-weather hybrid stock and crypto portfolio. 3 funds. That's all. So let's get right into it. So fund number 1, XEQT. Now, XEQT is a popular fund. It's BlackRock's iShares Core Equity ETF. It's the best risk-adjusted set it and forget it fund for global stocks. No competition. Some people simply put all of their investment capital into this fund as a substitute for the S&P 500. And now I know some people will also mention VEQT, which is Vanguard's almost identical fund, but I prefer XEQT because its Canadian exposure is smaller. I'm just not a huge fan of the Canadian market overall. XEQT holds more than 9,000 holdings from all over the world, 45% from the US, 25% from Canada, and 30% from the rest of the world. Super low management expense ratio of 0.20% and pays a quarterly dividend, which comes out to approximately a 2.2% dividend yield. And we make this fund 50% of the portfolio, and it will act as a portfolio backbone. Think of XEQT as your global stock market beta. It owns everything. No home bias, no sector bias, just owning the world. XEQT returns approximately the same returns as the S&P 500 does, with similar volatility characteristics. However, instead of concentrating all of our backbone fund in America, like you would with the S&P 500, we spread it across the entire global market for more diversification and therefore more protection against concentration risk. And when the more volatile parts of this fund that we'll talk about next start seeing drawdowns, XEQT is there to help cushion the blow of the portfolio. Again, we are using XEQT as the rock hard defense of the portfolio, not the growth engine. Now, why not use the S&P 500 instead of XEQT? Because this next fund gives us all of the American market exposure that we need. Fund number 2, the QQQ, the NASDAQ, or technically known as the Invesco NASDAQ 100 ETF. This fund makes up the next 25% of our portfolio and is considered one of the 2 growth engines of this portfolio. More volatile than XEQT, the NASDAQ offers us American tech exposure, but there are also, funny enough, some big names in here that are not tech related, such as Costco and PepsiCo. We hold 25% of the portfolio in this fund because AI, crypto, and tech are going to be at the forefront of societal revolution in the next 10, 20, 30 years. And there's no country, no, not even China, more prepared than the USA for this transition. This fund will see bigger drawdowns than XEQT, guaranteed. But remember, that's why we have XEQT in the first place, to soften the blow in the bad years for the 2 growth engines of this portfolio. This fund has a management expense ratio of 0.20% and has grown at approximately 15% annualized growth rate since 2010. And finally, fund number 3 to bring it all together, Bitcoin, specifically IBIT, the iShares Bitcoin ETF from BlackRock. Now, why Bitcoin? Because it's the scarcest asset on planet Earth, period, the end. If you don't understand that right now, it's time to read the Bitcoin Standard. Everyone gets the price they deserve with Bitcoin. Bitcoin is the jet fuel being injected into the engine of this portfolio. Super volatile, technologically superior digital gold. And we are buying IBIT instead of spot Bitcoin because with IBIT, we can invest in our tax-advantaged accounts. For us Canadians, that's the RRSP and the TFSA. And for the Americans, it's the Roth IRA and the 401k. Now, Bitcoin's cumulative annual growth rate since 2010 is an insane 210%. Now, obviously, those types of gains are behind us, but I would guess that the current cumulative annual growth rate of Bitcoin would be around 40 to 50%. So yes, more volatile than the NASDAQ and definitely XEQT, but the returns are asymmetrical. Bitcoin will make up the last 25% of our portfolio. So to round it all together, the Apex Wealth Collective portfolio is as follows. You get 50% in XEQT, 25% in NASDAQ, and 25% in Bitcoin. So if we were to invest $10,000 to start this portfolio, for example, we would allocate the following: $5,000 into XEQT, $2,500 into the NASDAQ or into the QQQ, and $2,500 into Bitcoin, or in our case, IBIT. This is not a one-cycle portfolio where we just hold for 4 years or a couple months. This is a portfolio that we hold and we DCA into forever, or however long you need in order to retire. The choice is yours. You can choose to rebalance the high growth funds into XEQT for more protection as you get older, and as the QQQ and IBIT outgrow their initial allocations heavily. But if you have higher risk tolerance, like myself, you don't even worry about rebalancing. We hold 50% of the portfolio in XEQT for stability and for balance. We hold 25% of the portfolio in NASDAQ for growth. And we hold 25% of the portfolio in IBIT for asymmetrical opportunity to the upside. Altogether, this portfolio spans a wide range of assets, providing balance, stability, and a healthy serving of future-proofing with tech and Bitcoin. A hybrid portfolio including the best of both worlds in stocks and in crypto. Now let's move on to the backtest. And please take the backtest with a grain of salt, because the backtest is only able to go back until February of 2024, because that's how far back the software was able to gather data for the IBIT ITF. So, take it with a grain of salt. So remember, these are very short-term performance metrics, and I will update these metrics as time goes on to get a better idea of this portfolio's performance, but let's compare them anyways. So first, here's the AWC portfolio allocations, as we talked about earlier: 50% XEQT, 25% QQQ, and 25% IBIT. And we'll be comparing them to two benchmarks. First, the traditional portfolio, which would just be 100% XEQT or a similar fund. It could be VEQT as well. And secondly, the S&P 500. So here are the initial results of the AWC portfolio. We've done a 38% annualized return since February of 2024. Granted, a higher standard deviation of performance and a higher drawdown than the S&P 500, which is expected. Next is the traditional portfolio, which is just a 100% XEQT portfolio, a 24.6% annualized return in the same time. Also, less volatility and standard deviation of performance, but also 14% less annualized return than the AWC portfolio. And here is the final performance summary table of all three strategies. Starting with the $10,000 investment in each, the AWC portfolio turned $10,000 into $17,564, while the traditional XEQT portfolio turned $10,000 into $14,693. And lastly, the S&P 500 benchmark turned $10,000 into $14,431. So as you can see, the S&P and the XEQT funds are pretty much in line with one another. Now, I don't know about you, but I'm willing to take a sharper maximum drawdown from much higher growth in bull markets. Now, volatility may bother you more than it does for me. So in that case, you can tweak the 50-25-25 allocation if you really want to, or rebalance annually. But personally, I don't care about the drawdowns. I don't care about the Sharpe and the Sortino ratios. It's all nonsense meant to scare you out of taking some risk. I care about the final number in retirement. You aren't selling this portfolio every year, so why would you care about the drawdowns? You should be DCAing into this portfolio and not looking at it for 10, 20, maybe 30 years. Now, will the AWC portfolio see bigger drawdowns than the posted 10.92% here? Of course. Speaking to Grok, the XAI, the typical XEQT or S&P 500 portfolio will see a 50 to 20% drawdown in a bear market, whereas the AWC portfolio could see around double that, around 30% drawdowns. If you're okay with that, then this portfolio could be for you. I definitely love it because it fits my risk profile perfectly. This is a portfolio that I could DCA into every week or every month, never check the portfolio performance, and sleep like a baby at night knowing I will consistently outperform the benchmarks over longer time horizons. Again, this performance profile we looked at today was only for the last 20 months or so. So it's a very short period of time, and it includes no bear markets, which will skew the performance. I will admit that. So take it with a grain of salt, but I am fully expecting this portfolio to outperform further into 2026, and then we'll start to see how bad the drawdowns will be at the end of 2026 or early 2027. But by then, I'll just have cash ready to buy the massive dip. Now, if you've stuck around this long, go ahead and catch another one of my videos right over here, or check out my channel over here, where you can take a look at all the other content I have to offer about investing and my personal investing journey. Now, that's all for me today. I'm Patrick with Apex Wealth Collective. Take care and see you guys in the next video.